Welcome to the 401k Audit CPA Success Show, where we're 100% focused on helping companies across the United States prepare for their 401k audit. If you have 100 eligible participants in your 401k plan, then this podcast is for you.
Hello, everybody. Welcome to today's 401k Audit Podcast. Once again, joined by Kim Moore and Karen Hill. And prior to the show, Kim was kind of telling us that they just signed their first engagement letter under the new SAS 136. So we figured it was time to revisit this topic. We know we revisited. We had a brief podcast on it a while ago, but we wanted to make sure we went into a little more details now that we're a little deeper into it. So welcome to the show. And Kim, are you ready for this? Ready for these changes?
I don't know. I don't know if I'm ready yet or not. I'll tell you in a couple of weeks. We have a professional, our AI CPA, which is our professional kind of governing body, is doing a two-part CPE session on it. So I'll let you know in a couple of weeks whether we're all prepared or not. But I think we are. Let's start off first. I mean, for those people that are not accountants and not auditors, they're probably like, SAS one, what? What are you talking about? I know it's, it sounds kind of legalese, but for those of us that are accountants and are auditors, we have, of course, a whole series of regulations and rules we have to abide by. That SAS actually stands for Audit Standards, Statement on Audit Standards. And there's a whole series. Obviously, it's up to 136. So there's 135 other ones that have come before this one that govern those of us that are in audit, the kinds of things we have to do, the rules of the road, if you will, that we have to abide by. So this is a new standard. It was put into play actually a couple of years ago. It could have been early adopted. So if you are listening to this and you have an auditor and they've already talked to you about this, you may already be doing some of this. That is possible. But most audit firms that we've been in contact with have said they were going to wait until they actually had to enact it, just because there were so many other things going on with the pandemic and just other things going on. So it actually becomes effective for years ending on or after December 15th, 2020. So that's obviously the entity. And in this case, it would be a 401k plan that you're auditing when their plan year ends on or after December 15th. So you're thinking, well, that's a couple of months away, but actually those audits will be beginning here pretty soon. So we thought this was a timely topic because it is going to be coming into effect here pretty soon. And there are some things you need to do ahead of time. So that's why I thought good timing for this to get everybody ready as we're heading into the next, couple of months and getting ready for those audits that will be starting here pretty soon. Folks that might want to listen to this, I think there's kind of two entities or two groups that might want to listen to this. One, if you're an auditor, obviously, and you haven't heard about this, this new audit standard applies to benefit plan audits only. It is the first audit standard specifically for benefit plan audits. Always before, we've had to cobble together a whole bunch of pieces and parts from other audit standards really meant for other kinds of audits and applied them to benefit plans. This one's specific for benefit plans. So obviously you do these, you haven't heard about it. This is a very timely topic for you, but really I kind of geared this more to if you are the plan sponsor. So you're a company that sponsors a 401k plan and either you have an audit, that you've been doing for the past few years, or one's upcoming. And you might say, well, that's for auditors. What do I care? That doesn't impact me. I'm not an auditor, but it does impact you. And so those are the kinds of things I think we're going to talk about here in just a little bit.
Great. So let's jump in. And so Karen, I'm going to throw it over to you. And I think the first kind of topic is just making sure that our listeners understand kind of the type of audits that are performed. So if you kind of want to walk down that path a little bit and explain that for everybody.
Okay, well, in the past, what we have called a limited scope audit is now going to be referred to as a 103A3C audit, which is something that yes, I know it's a lot of words, and it's something that we're going to have difficulty ourselves changing because it's been called limited scope for so long. I mean, as long as I've been in auditing, which has been a long time. So the full scope, what used to be called a full scope audit, is now called a non-103A3C. So, and there's basically the difference between the two is generally, as far as the auditing is concerned, is that for the non-103A3C, we have to do testing on investments and investment gain and losses and income, basically. So that part of it is still the same as far as the testing part. There's other things involved in it that is going to change. There's going to be an emphasis now on management activities surrounding the audits.
So that's where the plan sponsor comes in, I'm guessing. And so that's really what we're going to talk about today is obviously the name changes, which since I'm not an auditor, there's no way I'll memorize that. I'll have to refer back to my notes over and over again. And I'll probably still call it a limited scope audit, but that's just the non-auditor in me.
It gets very confusing. Which is which? It's 103A3C, but which one is the old limited scope? And then what? Just for those people that are like, why in the world would you name something 103A3C? That actually relates to the ERISA provision that allows for this whole difference in the two different audits. So that's where that 103A3C comes from. And just real quick, a little bit of background. The reason for this, partly this change, is that they really want the auditors to be able to fully audit the plans. They want to get away from a disclaimer opinion. So from an audit standpoint, I'm not going to talk a lot about this today, but we will be actually issuing full opinions now, which we were not allowed to do before. And so it's really going back to the roots of ERISA, what required the audits in the first place, but what really the intent of it was. And that's kind of the background of it and the real rationale for why we even doing this in the first place. But that 103A3C goes back to ERISA.
So how do I tell what type of audit I need then? So where do I start?
Yeah, and in reality, this isn't much of a change. It is a little bit of a name change going from the limited scope to the 103A3C. But the real emphasis in the standard is that the type of audit determination should be made by the client. So if you're the plan sponsor, you need an audit. It is really your responsibility to determine which of these two is appropriate, which I know is a lot, because most folks that we deal with that are our clients and potential clients, when I first just would even mention a limited scope, they're like, I have no idea what you're talking about. So it is a little bit, it's not really that complicated, but it's not something that people that are plan sponsors deal with on a regular basis, just because they're not the auditors. They didn't feel like that was their responsibility. So as Karen mentioned, the real reason for the difference goes to the assets themselves. So if I was a plan sponsor, first thing I would do is look at who is holding the assets. So what entity is actually physically holding the assets for you? That's not going to be you at the company. It's probably not going to be who you work with on a regular basis. So on a day-to-day basis, things may be happening with your plan, money in, money out, questions of participants and all that. Whoever you're dealing with is probably not the asset holder. That's usually a record keeper, TPA, someone like that. So you really got to dig down a little bit and figure out who's actually physically holding the assets. If that entity is a firm or a company that is regulated at the state or the federal level and they're audited on a regular basis, they can qualify to give you an asset certification that can be used. They're kind of a qualifying institution. Now it gets a little bit complicated here, and I want to make this as simple as we can, because I know this is, for most plan sponsors, are like, what in the world is she talking about? The easiest way I think of it to look at this is find out who that asset holder is. Are they an insurance company? Is it held by a trust company, or is it held by a bank? The answer to any of those is yes. Probably you can go down the limited scope, the 103A3C route. If it's held by some other entity, and especially if it's held through a broker dealer, then you're not going to be able to go down this route. Those are the probably two easiest ways to look at this. we actually have a booklet. We're going to talk a little bit more about the actual certification itself, but we have a booklet that comes from the AICPA on this topic. So if you're listening to this podcast and you really want to dig into this a little bit more, or you know who your asset holder is and you're a little confused on this, just shout out. No, Jamie, you're going to be giving us an email address here in a little bit, but just send an email to that address and we'd be happy to give you a copy of that booklet. It's through our quality center that we're a member of. We have access to a whole variety of different kind of training materials. And that booklet goes through in a lot more depth than I just did on the differences in the institutions. But that's the first thing. Let's find out who holds the asset, what kind of institution are they, and then that can kind of steer you at a high level down the path. The other thing that you want to look at, though, is what kind of assets do you have, and are they held by this institution? We see quite a lot of our clients, the vast majority of them, all of the assets are held by this institution. So it's a no-brainer. They're one of these banks, insurance companies, et cetera. They can give you the certification. All the assets are with them. Easy. It's a 103A3C audit, and probably that's the route you want to go. But we do find, and I don't want to say occasionally, it actually happens more often than occasionally, where some of the assets are with someone else. So they may have, as part of their assets, an insurance policy for some of the participants. That's held, of course, by an insurance company. Maybe the rest of the assets are with Fidelity, as an example. Well, Fidelity is not going to be, holding an insurance policy. So then you got to look at, for all of these assets that are outside of this entity, what are they? How big are they, dollar-wise? What kinds of assets are they? As you start getting into those kinds of discussions, I would talk to your service provider and especially your auditor, because it really gets down into a dollar amount. There's no hard and fast rule. A lot of times we find these outside investments are small, so we can still go down the limited scope 103A3C route, but not always. And they may be significant enough that by definition is going to throw you outside of that. So another thing to consider.
So it sounds complicated, but at the end of the day, it really isn't. I think you just need to make sure you ask the right questions and talk to the right people, and you're gonna get the right answer. Like I know, again, it's been a long time since I've been in audit, but very rarely have we started going down the wrong path when it comes to this. Like usually going into the audit, like everybody knows what type of audit it is, and if you're having trouble finding the certification or getting the certification, then that something's wrong there. But usually you don't get to that point. So
right. I would just caution you to be careful. I mean, another way you can start with this exercise is go to whoever you work with and say, hey, I got to figure this out. I need a copy of your assets, and if they can't give you one, then, you're done. You got to do full scope. But also be careful, because we have seen people come to us and say, yeah, I got certification. Here it is. And you get looking at it, you're like, yeah, no, that's not going to work, because it doesn't fit those other criteria.
Or they give you people misunderstand the request, right? They'll give you like an asset summary, but it's not certified. So it has to be a certified, this is your asset balance. And so, I mean, we've seen that before as well. So,
and there's specific verbiage that goes along with the certification to determine whether or not it's a proper certification.
Right. Yep. Definitely. And that's, again, you get a early certification. You can show it to your auditors and say, is this going to work? And they'll definitely tell you if it's the going to get you done that right type of audit. So again, spent quite a bit of time on that, but it's not as complicated as it sounds. Again, so I think most people can figure that out. So Kim, you promised, I don't want to lead people on too long. I'm going to throw the email address out there, so that way people have it and they're not waiting for the end of the show to get it. So again, for if you want a copy of that document, you can email us at audit@summitcpa.net. Again, audit@summitcpa.net. So love people to reach out to us for topics where they want to be a guest in the show as well. So I'm always looking for people to reach out. So okay, let's turn the corner here a little bit. Karen, I'm going to throw this back over to you. And it sounds like obviously we just talked quite a bit about understanding what type of audit you need, but also there's some client acceptance procedures here that need to go on both sides here. So if you want to dig into that a little bit.
Okay, as Kim mentioned before, the client is supposed to do the review and determine which type of audit is the correct audit to do. Go ahead and consult with your auditor if you need to. but ultimately it is the client's decision. And in the engagement letter that the auditor will send to the client, it needs to specify which type of audit is going to be performed. And some of the verbiage in the engagement letters has been changed to make sure that that the proper procedures are completed, or there's verbiage, I should say, in the letter to ensure that states that the procedures have been completed. And then the auditor's responsibility is to review the procedures, review with the client, make sure that they did do the necessary procedures in order to determine the proper audit.
Great. So that sounds, again, stuff probably we should have been doing, but I know the wording on the letters can be a little bit different. So it's important ahead of time to make sure both sides are in agreement with what that audit's going to look like. And then can we also mention auditor review here? You want to go into a little bit of that?
Yeah. The auditor is also going to review once you get into the audits, and once the engagement letter is signed, we've agreed the type of audit, assuming we're going down the path of needing the certification. We're also going to go through these steps. So there'll be a secondary check on our part. Of course, at that point, you might find something, deficient in it. So some of the verbiage is not there that needs to be. It needs to be actually signed. An email is not sufficient. It needs to be an actual formal document signed. There's other criteria. So if we see that any of that's missing, of course, that will flip it back over the other wall, and we'll have to do the full scope non-103A3C procedures. The thing I like to point out here, I think what's actually going to happen is that for a lot of the folks, they're just going to go down the same path that we've always been doing, and they're going to rely on the auditor. And of course, we're going to be able to coach them through this and help them understand what they need to do. But what I suspect is going to be a hang up for some folks is when they have their legal departments review those engagement letters. And that does happen quite often, actually. And the legal department is going to know anything about this. And so they're going to say, well, wait a minute, we're supposed to be doing what? What is this? And so here we go again. So that's why I point this out that, you don't want to have a couple months delay getting your audit started because your legal department doesn't understand this. And really, it's not that big of a deal, and it's not that big of a change. But it could cause you problems if your legal department doesn't understand that, and they don't want you to sign it because or they don't know if you did all that as the company, and so they come back and say, hey, we need to strike all this out. Well, we can't do that. If we strike it out, you've automatically made it a full scope. Now you got to pay more, either it's going to take longer. So we just don't want to have people go down that road when really it isn't necessary. So we're trying to get the word out to everybody. I think that's probably the most important part of all of this, just having everybody understand.
And timing wise, right? Obviously we're in the fourth quarter right now of 2021. So again, there's obviously this is the quarter where a lot of this goes into effect. So this is the timing to do it. I know it's seems like the 401k audit is still months away, but if you can start doing these procedures now, talking to your legal team, making sure they're aware of what's going on. Again, a lot of times it just comes back to communication and timing. Like if you're waiting until June to do this, it might not be the best, but now's the time to start having these conversations. So
absolutely. Yeah. And we're talking legal. So let's jump into our next area, plan documents. This is actually a pretty simple one, but we expect probably going to be a pretty problematic area for a lot of our clients. And we expect from a lot of other folks. It has always been the case that the auditor needs to get a copy of the current plan documents. And there's a whole suite of them. That's not just one thing. It's a whole suite of documents to conduct the audit, because we need to know what are the parameters that the audit or that the plan is supposed to be operating under. None of that changed, same as before. The standard now, though, calls out specifically, it is management's responsibility to ensure that they maintain all the documentation for the plan, including, it calls out specifically plan documents, signed, executed versions of the plan documents, as well as any and all information and documentation required to support transactions maintained by the plan. So we know most 401k plan providers are using service providers for almost all aspects of their plan anymore. They're in-house doing the hiring, terminating of their employees, and they're running payroll, usually in-house, not always the case, but usually in-house. Other than that, almost all of this work for a 401k plan is being done by a service provider of some sort. There's varieties of them. And, as we talk to our clients, they're like, well, that's so-and-so's responsibility. We pay them to do that. They'll have that. Maybe they do, maybe they don't. But ultimately, it is very clear it is the plan sponsor's responsibility to have this documentation or to know someone else has it and can provide it. So we bring up the plan documents as kind of the first step, because it is, I would say 90+% of the time, no one has a good, available, quick to grab copy of the signed executed plan documents. I mean, this isn't every once in a while it happens almost all the time. So we've been really making it a point to try to push to get those copies, to tell our clients, hey, you need to have these. You should have them anyways. But if you don't have them now, go get them. And if nobody can find them, you need to re-sign copies, because we're going to have signed copies. So again, we're a couple months out. This would be a good time. Go check your file, see if you got it. If you've only got a paper copy, I'd scan it. So you got an electronic copy. And if nobody has a copy, you better be checking with your provider so you can get one, because that's going to become an issue and a big, huge time delay as we get into audit season.
Yeah, that definitely makes sense. And like you said, the timing is right now. So hopefully people are listening to this and jumping right on that. So, okay, Karen, let's jump into a word that auditors have talked about for a long time and have always thought a lot about, and that's estimates. So, estimates obviously from the audit standpoint are a higher risk. Anytime there's an estimate, it's something that we're going to have to dig into and make sure that the estimate is reasonable. So it sounds like with this new requirement that we're not going to be the only ones talking about the word estimate. So you want to dig into that a little bit?
Sure. Actually, for years they've said that the client is the one that's supposed to determine if the estimates are proper, but a lot of them fall back on the auditor to do that. Luckily, in most 401k plans, the estimates, the main estimates are the value of the investments themselves, and most of those are usually mutual funds, some stocks, things that are readily traded, and the valuation is pretty easy to determine. But there are some plans that have some strange investments, maybe some real estate holdings or other types of bonds or CDs or something that the valuation might not be as easy to determine. And in that case, the plan sponsor is the one that's supposed to determine the estimate of the valuation of those investments.
So estimates, again, I'm going to use the old term just because I don't have my notes in front of me, but are estimates, do they ever exist on a limited scope audit, or are they usually on just the non-limited scopes?
Yeah, they exist on both.
Okay.
Both types of audits, because both of them are going to have investments. So it's something that we need to look at no matter what type of audit that we have. And the auditor is going to review the valuation of the estimates and determine if that's proper.
Okay, great.
Yeah, and this is an area I think it can get very complicated. For most plans, probably not, but there are cases where it is. So again, I would talk to your provider, talk to your auditor. If you have an investment advisor, that's another place you can go, because they'll have some good information, especially if they're kind of strange investments. Those kind of non-public ones, they should be able to kind of point you in a direction to help you in this area.
Okay, great. All right, Kim, now we're going to turn the page a little bit here and talk about, what, I missed something?
Going concern?
Oh, yes. Yeah, I was going to say,
yeah,
the word that no one likes to hear, but everybody has to
likes
understand.
Going concern. Yeah. Again, this is something, as Karen mentioned earlier, this has been around forever. It's been something we should have been doing all along. Nothing new here. Going concern applies across the board. Whenever you're doing an audit, you always have to look at going concern of whatever it is you're auditing. In this case, we're auditing 401k plans. So there's a couple of wrinkles. I mean, obviously, we want to know, is it in the process of being terminated? Are there discussions about terminating the plan? Obviously, that would be a going concern issue, because the plan's not going to go on if it's going to be terminated. That kind of goes without saying. But we also have to look at the underlying company because without the company, although the plan could be, it is a standalone, it does exist on its own, and it could go on. Usually they don't. So if the company is in any kind of financial difficulty, there needs to be a going concern evaluation related to the plan. Again, that's all supposed to be done by the client, not by the auditor. The auditor will review it. The auditor is going to assess it and come to a conclusion, but ultimately it's supposed to be done by the company. It gets a little difficult. So again, I would suggest, this is probably something that's best to talk to your auditor about. I don't know that your service provider is going to be able to help much here, unless you're in the process of terminating the plan. But, I would just think about what's going on with your company. Think about how did that impact the plan? Did you have any delays in transmitting contributions? Did you shut off employer contributions? All those kinds of things will lead the auditor to say, I don't know, there might be an issue here. Another thing that's a wrinkle for 401k plans is something called partial plan termination. So you've not done anything. You're not terminating the plan. It's going to go on. The company's going on. So you'd be like, why are you even bringing this up? But if something happens that causes 20% of the participants to be involuntarily terminated. So not that they're leaving on their own, not that just a whole bunch of people in your company decide they want to work somewhere else, but something happens. So you're closing a facility, you lose contract, you just decide to shut down a portion of your business. If that number gets around 20%, then you can trigger this partial plan termination. Really only impacts a plan if they have employer contributions that have a vesting schedule to them. But it's very complicated and it's very tricky, and there's not a set, I just go down this little chart here and it tells me. There's a lot of different rules around it, different things can apply. And it can be very costly if you miss it, because you can have people that have left your plan. You took money back because they were not vested according to what you thought was the rules. Actually, it fell under this partial plan termination. Now you got to go fund all that. So the company would have to make up all of that difference. So it could end up being a big costly mistake. So if you've had anything, and we just went through a pandemic, so this could apply to a lot of plans that it normally wouldn't have. And there are specific rules too, specifically for the pandemic, because people may have been laid off and then you hired them back. So if you did lose some people, regardless of how, I would suggest go talk to your service provider, and you may actually need to get an ERISA attorney involved, because it does get very, very complicated. You talk to your auditor, but ultimately it's usually going to be an attorney call. But it's worth your while to look into it if you think at all it might apply, because it can get very expensive if you miss it.
Yeah, this definitely sounds like a year where you need to pay attention to that. I know a lot of not only like you said, people changing people, but also just a lot of companies changing the way they do business. I always think of like the restaurant business. Like the one thing I've noticed lately is it seems like the dining out is continuing past the pandemic. Like, you used to go to a restaurant before the pandemic and it'd be 75% full, and occasionally you'd see someone walk in with takeout. And now it's like, you're sitting in there and you're the only person in the restaurant, yet you see 50 people coming in and out. And so I think stuff like that is going to change. Like you said, maybe you're going to close storefronts and have more just delivery options and stuff like that. And so I think that, a lot of businesses are changing the way they do things, which might lead to something like this. So it's a really good year to kind of make sure you're ahead of this, because again, as with anything, you want to make sure that further ahead of it you are, the easier it gets. So,
right.
Okay, so let's talk taxes for the 401k. So let's go into the 5,500, Karen. So what kind of changes and what things do we need to be aware of in that area?
Well, some of the things haven't really changed. Some of the things that we need to do we've always, at least our firm, we've always needed to review the 5,500. We need to reconcile the report financials to the 5,500. That's something that we've always done. That doesn't change. The one thing that might change is that we cannot date the management representation letter or the audit opinion until we have a substantially complete Form 5,500. Now, what's a substantially complete Form 5,500? That's something that you need to determine with your auditor, what they determine substantially complete. I can tell you from personal experience that it is rare that we get a draft of the 5,500 and there's no changes to the 5,500. So depending on what those changes are, I think some of the issues that we had this year, we were changing audit opinions, and that had to do with the Form 5500 had already changed for this standard. And a lot of the audit firms decided to push it off for a year. They didn't want to go ahead and early adopt. So maybe some of those issues will be resolved because, everybody's now going to be doing the 103A 3C audits this year. But because we need to get a substantially complete Form 5500 before even issuing the rep letter, if you don't get one until right before the deadline, it could cause a delay in filing. So that's something that you might need to stay on top of, talk to your service provider and see when they plan on giving you a draft of 5500, and also discuss it with your auditor and make sure that they're going to look at that early enough that if there is changes that need to be made, they can be made timely and get a revised draft back to you.
Yeah, I think timing is the key here, because certainly you can revise a 5500 as many times as you want. It's not that big of a deal, but it's a timing issue. And it's very common for audits to go right down to the wire, and it's also common for 5500 changes, depending what they are, to take a week, 2 weeks, 3 weeks. So obviously, you get down to the end, you need a substantial change. The auditor's not going to get you the final report. Without that, you're going to file late, and nobody's going to be sympathetic if that happens. So we're just putting this out here because we know different firms are going to determine what's substantially complete, and they're not all going to be the same. So you need to know that ahead of time. You need to make sure your auditor's thought about that. And you also need to be talking with your service provider. What's the last day you can be submitting a change and get it back in time? So it's really a timing thing more than anything. But we've seen problems with this in the past, and now we have no flexibility now from an audit standpoint, where before we could kind of say, well, we got a draft, it's close enough, we can go ahead and get you now we can't. Which just full stop. There's nothing we can do about it. You don't have it, we're done. You're gonna be late, and there's nothing anybody's gonna be able to do about it. So we bring it up now.
Sure. Yeah, I remember, again, I always think back to the 5500s was always like the key procrastination. Like once you have those 401k financial statements done, and you have the financials finalized, it's pretty easy to jump into the 5500. But I remember waiting months to see that first draft of the 5500 after the financial statements were done. So I think it's very common in the past to do that. So I think it's time just to change your mindset. And, while the 401k is fresh in your mind, let's just get this done and get it out there. So that way we can, wrap everything up. So hopefully it does change that bad habit. So we are right on time here. So I know we have one topic left. So I'm going to throw it over to you, Kim, to kind of wrap up the podcast for us.
I'll just do this really quick. It's called Reportable Findings. We were always supposed to, communicate back to the client any findings that we had. No change there, but there is this definition of reportable findings. So it can change what findings are going to get reported back to you and how they're going to get reported. So my suggestion in this area is just talk to your auditor at the beginning of the audit, as you're starting this new kind of cycle of audits, and say, hey, well, from your opinion, what's a reportable finding? If you want every finding, even if it's tiny little, doesn't matter, let your auditor know that. They can communicate to you verbally anything. They can give you a separate written communication. So there's ways you can handle this, but I just would talk to your auditor and say, I heard about this thing, reportable findings. Can we talk about that a little bit? And you can get that taken care of right away, but I would just bring it up, at the beginning. I think the whole thing with this is, if your auditor was doing a good job before, you're not going to see a whole lot of change, but it's communication and timing are the keys. So as long as you talk to your auditor up front and make sure they're on board, they know what they're doing, they're handling all this properly, talk about any of these areas that may have piqued your interest that sounds like a problem for us, talk to your auditor and do it now, don't wait. And you do that, I think you'll be fine. It's not that big of a change.
Yeah, definitely. If you haven't heard of this yet, I would, the second you get off, listen to this podcast, I would give my auditor a call or shoot an email out and be like, hey, I heard about this new standard out there. Is there anything we need to be doing to be ready for this? Because you want to make sure you're ahead of it. So,
absolutely.
But hopefully this podcast helps, and definitely appreciate both you, Kim and Karen, and appreciate you guys coming on and informing me as well as the audience. So thank you very much.
Jamie.
Thanks.
Enjoy this podcast? Visit our website at summitcpa.net to get more tips and strategies for achieving 401k audit success. We're here to be a resource with ever-changing rules and regulations.